Steve Sapeltal, National Deal Advisory Strategy Leader for Healthcare and Life Sciences here at KPMG. Steve, the floor is yours.
Perfect. Well, thank you for that long-winded intro on how to get CPEs, but welcome everybody, and very excited to be here today and kind of going through our investment outlook and where we're at in 2022. Joining me as part of the panel today is Kristen Pothier, our Global National Strategy Leader for Healthcare Life Sciences Deal Advisory. We have Jeff Stoll, who is our National Leader for Life Sciences, a partner as well. Ross Nelson, partner in our Healthcare National Leader, and then Breck Glover, a partner in our Healthcare Life Sciences Financial Due Diligence practice. So great group of individuals today to walk through the panel. So thank you panel members for jumping in. The agenda today is going to hit a couple of things. One, I'm going to start with a couple of high-level investment trends that came out of our survey in our paper that we did. Also, we're going to talk specifically about some 2022 trends across both healthcare and life sciences subsectors. We're also going to highlight and hit a couple of points around items that could potentially impact the M&A in 2022, things that are happening around interest rate hikes, inflation, and other topics, and what that means to you within your particular subsector. And then finish with a little bit of a wrap up and where are we going forward and the path forward. So that's our agenda today, and looking forward to the discussion. First thing on a couple of the investment trends that we've seen. 2021 was a great year for M&A. I think we all felt the passion as well as the limited resources in executing. When I look at the kind of the healthcare or the life sciences side specifically, we had over 460 average on a quarterly basis transactions, which was an increase significantly over the 405 in 2020. On the healthcare side, we saw a continued increase in the home care, hospice, personal care transactions, as well as an increase on the overall hospitals and the size of those transactions. The one thing I'd say, we're 2 months into 2022. We've seen a couple of trends already. Beginning with the beginning of the year was a little bit slower, but we also knew that because of the number of transactions that we're trying to get finished at the end of 2021, and we were just short on resources to kind of execute on those deals. But also we did see some smaller and mid-sized transactions at the beginning of the first couple of months. But we fully expect that going forward in the middle and the back half of the year to see some larger transactions that might even fall into the category of transact to transform. So we're really excited about fiscal year 2022 and the excitement around M&A. So having said that, I think we have our first polling question. So this is the fun part of the CPE process. So what subsector do you represent? You will see this slide here for maybe about another 30 seconds to give you a chance to answer the question, and then we'll keep moving forward. So I think we'll move to the next. Thank you. So Kristen, do you want to jump in?
Yeah, that sounds great. And so while you're all answering those poll questions, let's dive into the data. So what you're going to be seeing today and the observations that we have are based on our deals and strategy work around the world, and a market survey of over 300 healthcare and life sciences executives. And we really cover a number of the different subsectors across healthcare and life sciences. So within life sciences, we really span the continuum of everything from biopharma to diagnostics to lab services to biopharma services to medical device. And then in healthcare, similarly, we look through, of course, across in healthcare IT, the hospitals and health systems, behavioral health, which has been especially interesting this year, specialty physician practices, and home health and hospice. And so when you look across all of these, and myself and my colleagues are going to be spending time in each one, just know that our investment report has more detail and more data that you can look at and talk through as you go through your days ahead. The next slide really dives into a couple of the key components of what we're seeing, and I'm going to turn that over to Brett.
Yeah, thanks, Kristen. So when we think about this survey, let's walk backwards a little bit first. We think about where we were coming out of COVID. What you realistically found on the deal side is what I'd call a hyper market, and it really picked up in basically the fourth quarter of 2020 and ran all the way through last year. But like as Steve alluded to, there's a little bit of a slowdown in the fourth quarter. And I wouldn't say it was actually a deal-making slowdown fully. There's a couple different factors that went on there. One was for any deal of scale, if you wanted to get government approval, you basically had to have submitted by November 1st. And so what that is, it put a little bit of pause on what could get done and what couldn't. The other piece is, from everything we've heard, there was legitimately some market fatigue. Investment banks were being told by sponsors saying, hey, I'm just not going to look at the book. I can't do it. And so they held some processes out. And so what we saw was coming through the year, especially in the fourth quarter, and it's kind of hung over a little bit into this year, was probably a little bit of a delay in activity. And so what I'm saying is what we can tell today is through February and into March, we can see the activity picking up, but there absolutely was a little bit of a slowdown in the market. And I'll talk about this slide, which is very interesting because this survey was done approximately in October and November of last year. And so what you see is at this time when we asked respondents what they believe, said, hey, it's going to be even a better market next year in 2022. And I think what we'd say is nothing's necessarily changed our opinion on that, but we absolutely did see a little bit of a slowdown in the fourth quarter and coming into the first quarter. So let's go to the next slide and talk about what's changed since our survey respondents filled this out. So obviously a lot of big things here, and I'll share a little bit my perspective on the healthcare side, then hand it around for everyone else as well. One, increased inflationary pressure. No question, we knew that was coming, but we're seeing it become more and more clear. On the healthcare side, it's hitting heavily on labor. We're seeing a lot of issues with that, and I do think there's actually going to potentially be some pressure on organic growth because of some of the labor shortages. The next piece is the geopolitical tension, and obviously as we talk about this is a business conversation. It's you know, I don't want to overlook that. Obviously, it's a very concerning human issue as well. So we'll move past that piece and just say, what do we think it's going to do to impact our conversation here? And I would say immediately, it's obviously fairly recent. We're not necessarily seeing anything in the deal world where deals are pausing, or we're getting comments from, our private equity team's capital markets group saying, hey, we can't get debt or anything like that. Obviously, it's something we have to continue monitoring. The next piece is, as we've heard, is interest rates rising. I think it's interesting here is on the rising interest rates, from the conversations I've had with our investment bankers and others, the increase in rates in of itself can impact deals, but it's not necessarily the biggest issue we have right now. The bigger issue or the bigger concern might be is if we see a change in the amount of debt leverage we can put on deals. So for example, in 2021, if you could get 4 times leverage on that, if that goes down to 3 times leverage, that's going to be a little bit more of a significant issue for getting the deals done because the potential returns that you could get based on your capital structure may change. And so we haven't seen that happen yet. But that's one we're going to continue monitoring because in years past, we've seen that happen. What you find is potentially a little bit of a disconnect between buyers and sellers. Changes in the capital structure puts kind of a little bit of pressure on the return, how much you can offer. Again, 12 times, 13 times, 14 times. But every seller, once they have in their mind, hey, my friend just got 14 times for their dental platform, they want 14 times. And so again, we haven't seen that today, but that's the one that I'm monitoring a little bit more closely, potentially to see, do we see a couple bumps in the road, maybe in the third quarter and fourth quarter. If you see some pressure there, there might be some disconnects between what buyer and seller expectations are. Then the last bullet here, and I'll let Ross talk about on the healthcare side, is just what are we seeing with the FTC policies? Obviously, there was a lawsuit filed last Thursday that was pretty interesting. That does have a little bit of impact on what we're seeing there. So Ross, I'll turn over to you to talk a little more about what you see on the health system side.
Yeah, so Brad, thanks for mentioning obviously the United Change Healthcare deal, but also on the hospital and health system side, it's really interesting. Looking back a couple of years, FTC policy used to focus on health systems that were in the same market, and there was a specific market test for market share across their individual service lines to see if there was too much concentration of market share. But now we're seeing deals getting reviewed, having comments distributed once or twice for even deals that are in non-overlapping markets. So obviously, just from a might and size standpoint, the FTC is looking closely at health system mergers, even in non-overlapping geographies.
Maybe I should make some comments on the life science side. I think on the life science side, particularly around pharma. The FTC in the early days of the Biden administration came out saying they were going to re-review their approach to pharmaceutical deals in particular, and I think other large life science deals. There seemed to be a particular emphasis on any deal where they thought there were implications for drug pricing, where it might actually unduly raise the prices on drugs that were a part of that deal. It'll be interesting to see how that progresses, because I would argue that I think we've seen the industry from, say, since 2014 really move away from those spec pharma type deals where a major part of the deal thesis was to acquire sort of unique products that had unique attributes, but then could also support a significant pricing increase. Today, the vast majority of the deals that we're seeing across the pharmaceutical industry really are focused on acquiring more innovation and building the pipeline for future revenues. So of course, it's harder to make a judgment on what pricing might be 4 or 5, 8 years down the road, given the type of assets that are a part of that. So again, I think it's going to be very interesting to see how the FTC begins to review different deals, particularly ones that are focused on pipeline building. So far, so good, I think, across most of the pharmaceutical industry. But again, I think it'll be interesting should a mega merger between two entities such as AbbVie Allergan, where that will leave the industry. Will those type of deals be approved moving forward, or a BMS Celgene? I'm not sure in this current environment we would see those kinds of approvals, but again, it's to be seen still.
Before we go on, the one thing I'll pause on though is the summary I'd give you is coming into 2022. I'd say there's a little bit more uncertainty. Coming into 2021 this time, it looked very clear it was going to be a great market for M&A. We're not saying it won't be. There's just a little bit more uncertainty here. The things I feel a little bit comfortable about is, hey, we did see a little bit of delay and deals paused. I think we're going to see a lot more deal activity pushed into the rest of 2022. I think the fourth quarter could still be very busy. I think the third quarter is going to be really, really busy. The other piece I'd say on the healthcare side, for various reasons, I think we'll see a little bit larger deals. A lot of the deals we saw in the fourth quarter of 2020 and the first part of 2021 weren't that big. So a couple larger deals announced right in the fourth quarter. I think we're going to continue to see some bigger deals and bigger deployments of capital in 2022.
And then the final thing I would say on the life sciences side from a geopolitical perspective is we are seeing more and more companies do much deeper due diligence in region as more regions have to be self-sufficient. So for example, when you're doing a global launch and you want to be able to launch globally and you have a companion diagnostic or some other type of lab service, it's no longer possible to do that and cross border as easily as we would have before. And so we need to look at our Asia Pacific corridors, our European corridors, and our Americas corridors very differently. And that's something that's increasing the level of scrutiny around the due diligence that our companies have to do on our deals, and it's increasing the complexity of our commercial launches.
Perfect. So I think this takes us to our next poll question. So what issues do you see having the most impact on the deal market for 2022?
Great. So what we have on the slide here is just to revisit how the deal market has looked in 2020 and 2021. I think it provides really good context for what we're likely to see, at least in certain related to certain tailwinds in 2022. So as you can see, we've taken the approach that's a little bit different than other companies, where we've looked at the total deal volume across the different life science subsectors here. So the dark blue, for example, is biopharmaceuticals, and the lighter blue there is devices, and that purple is actually biopharma and lab services. And so as you look across here, while we do have the deal value in that yellow line, we are also tracking the M&A volume. And we think this is more important because if we actually included 2018, for example, on here, if you only look at deal value, it can really skew how much capital, how much activity is really going in through the industry. So for example, in 2018, we had the AbbVie Allergan deal and the BMS Celgene deal, which were north of 60 billion each, which could really skew the results from the typical deal volume that we see. So I think the take-home point here is across all the subsectors as we went into 2021, really we kept accelerating in terms of the total deal volume from 2020. As you can see, we topped out at 702 total deals across the sector. Pharma really remained alive throughout 2020 and 2021. There was a little bit of a dip maybe in the very beginning of the COVID pandemic in 2020, but it really accelerated through and maintained a lot of the activity. Similar on the diagnostic side, and I'll let Kristen comment on that a little bit more in a minute. But overall, those are the sectors that really really thrived through the pandemic, and we expect there to be multiple tailwinds that sustain them in the future, which we'll talk about in a little bit. Kristen, are some things on the diagnostic front that you'd like to speak to?
Yeah, both in diagnostics and biopharma lab services, you can definitely say that these days diagnostics is finally having its day in the sun. I think that the COVID testing and the billions of dollars that was poured in has made our companies in diagnostics and lab services cash rich, which allows them to both look at additional M&A and really look to the future and very much plan for the post-COVID onslaught of other types of testing that we go through. I think that when you look at innovation post-COVID, we've also seen that acceleration of innovation within diagnostics and lab services, which allowed even more M&A, much more even than in 2020. And we continue to see that even going into 2022. If we go to the next slide where we have a couple of other highlights, a final thing I would say on the diagnostic side and on the biopharma lab services side is that really it's a convergence of ecosystems. And so at the end of the day, when you look at diagnostics companies buying lab companies or lab companies buying diagnostics companies and really being able to have an end-to-end solution for our biopharmas and for our patients worldwide, we're seeing that because of the incredible M&A environment that we're in today.
Yeah, I think, as context for some of the tailwinds that we see and why even in light of some uncertainties that we're facing in the 2022 market, broadly speaking, we're in a giant sort of cycle of innovation across life sciences. It's everything from nucleic acid-based therapies, what's happening in oncology, precision medicine, advanced analytics and AI, to multi-omics, digital transformation. Basically every part of that life science value chain is being disrupted or evolving in significant ways. And it's creating a lot of investment across all the subsectors, be it in your CRO, CDMO space to keep up with all the innovation that's happening in the pipeline, all the way to how biopharmaceutical companies are investing heavily in next generation platforms. All that is to secure their future revenues and their pipeline has really been a big emphasis. The one segment that maybe we're leaving out here, which we'll talk a little bit later on, is the medical device segment. So I'll save that for a bit. But as I think, the convergence of a few different key trends here is, again, that the convergence of innovation, but then the COVID pandemic for many companies in this space really was a windfall. Whether it be on the diagnostic side or on the pharmaceutical side in terms of the pursuit of vaccines or therapeutics. There's many companies now that are extremely cash rich. Pfizer just announced record sales that they expect for 2022 with a guidance of 98 to 102 billion. I know that was a little bit under what analysts expected, but I mean, we're still talking a sizable jump for their performance. And I think that position, even with this, the stock market uncertainty, with interest rates likely going up, we're likely to see companies still put those dollars to work. And in fact, there may be opportunities as the market performs downward for certain companies to be acquired at a little bit of a discount. We do expect in our survey with CEOs that valuations will still run relatively high. But again, I think in comparison to where they were in 2021 and 2020, we may see a little bit of a break on that as the market maybe doesn't perform to the nosebleed levels we saw last year. I think when we think about headwinds, of course, we mentioned the cost of capital. Likely there's going to be multiple interest rate increases. But even then, most analysts that you speak to, really see that as, even if we get to, like, say, 4%, it's still, historically at record lows. And so it probably will not be too much of a deterrent to M&A. The FTC policy point that we made earlier is an area that we do think could create a little bit of a slowdown in certain areas, whether it be how they're reviewing financing, how they're reviewing particular deals and the fit and the impact on the market. So there may be certain types of deals that they really maybe put the brakes on a little bit. But again, I think through creative deal structures, we're going to see a lot more of the pharmaceutical industry heading that way, licensing deals. Again, I think the industry will continue to find creative ways to structure deals that will enable them to transact. In fact, we have another paper that will be coming out in a little while that will look at overall deal volume in the biopharmaceutical industry, not just at M&A, but actually other types of deals from partnerships, et cetera. And a theme that we've been seeing for several years now are those creative deal structures. We think that's really going to be the essential way. And the other trend that's driving that, frankly, is some of the companies that have made big investments in cell and gene haven't necessarily seen those integrations pan out all that well. Retaining talent has been a huge issue, and therefore putting at risk the viability of really seeing the full fruits of the portfolios they've acquired. And I think that's also giving the industry a pause on doing large multi-billion-dollar transactions in that space, that maybe it's really about keeping the carrot out there for these young, innovative companies and making them work for those payouts so they get to a more of a mature place before thinking about integration. So I think those trends are really going to be key on this industry and probably seeing more creative deal structures and fewer full-on large acquisitions. Kristen, are some additional points you'd like to make on diagnostics and services?
I think that you've hit the nail on the head with regards to innovation. I think that within this industry overall, we'll talk about med device again in a minute, but overall, other than the medical device space, we've just seen such incredible momentum with all different types of creative structures in our deals and in our strategies to be able to still produce the best that we can for patients, even through a major pandemic and a worldwide pandemic. And so I think that those of us that spend all of our time in this industry can be pretty proud of our industry, but we also know we have a lot more work to do. And so as Brett was mentioning, with some of the challenges as we move forward into 2022, we're already starting to see some of those components really come into play, and we'll need to be watching those and really working towards very complex and really thorough due diligence to make sure that the deals that we're doing in 2022 are as fruitful as the ones that we've seen moving forward. I think that next we have another poll question, so we'll go to that slide right now. And so if you think back to what Jeff just said, we're doing a little bit of a quiz for you. What are the projected to be the top deal types in biopharma? And so we'll leave this up on the screen for a minute.
Hey,
And
Jeff and Kristen, maybe while we're pivoting to the next slide, maybe a question for you. If we think of how much of the deal flow for 2022 might be related towards some of the pharma companies, device companies, looking at their portfolio and doing some rationalization and doing a round of divesting and then reinvesting. And how much do you see that as a trend kind of going forward compared to 2021?
Yeah, I think for certain companies, we'll definitely see that. Disposing or carving out lower performing portfolios will certainly be a trend that we're seeing. I mean, we already saw Merck sort of take the first shot of this, but I think we'll see other companies. Obviously, it's been publicly announced that Sandoz, for example, may be up for auction later this year from Novartis. So that's out there. I think we're going to see more and more of companies review that. That said, for some of the innovative big pharma companies, some of those established product areas are still healthy cash flows that they want to keep as sort of their base. So I think it's really a case by case situation in terms of whether or not those will be carved out or not. But I think the story in certain categories will remain what it's been. So areas of women's health are probably not going to be the most attractive area for the top innovative companies to perform in. That doesn't mean there isn't good value there, but that means more mid-market players may be looking in spaces like that. Similarly, biosimilar, I think, is in an interesting space right now for the industry. It wasn't that long ago where Pfizer and others were making really big bets in that space. And I think that's transitioning to more of a mid-market play with maybe a couple large players left trying to, really find value there. So I think we're really in an interesting time period where we will see some carve-outs in 2022 and probably 2023 as companies revisit their portfolios and the performance there.
across the life sciences service sectors, what we have seen is some rationalization there as well. You know, you can build a service organization to serve just about anything with regards to pharma and clinical trials, but there are certain areas that we're doubling down on. There are certain areas where we're putting them more towards our core clinical labs, and that will continue to mature over the next year.
And maybe the other area we shouldn't forget is just the crazy town that PE has been in the last 2 years with pharma services and other types of life science service companies. We've seen really high valuations and multiples on deals there, particularly things that are related to the nucleic acid value chain. So if you are a cytokine CDMO, viral vector CDMO, if you're in the CRO space on analytics, all those things are red hot commodities. There aren't enough of those companies, I think, for PE to find and invest in. I think we'll continue to see some really young up and coming companies in 2020 and 2023, in 2022 and 2023, eventually mature enough to be invested in. But early on, or I would say towards the end of 2021, people were really looking for those other next plays that were the Aldevrons or PepperTechs, because those were such great successes from a PE standpoint. So again, we'll see PE scouring the earth for those types of targets.
Now, if we want to go to the next slide, we'll cover some med device. And I think that med device is always one, as we go through this pandemic, that has just really taken some hits. And at the end of the day, PPE and respiratory devices and consumables were always, of course, hot as we went through the beginning of the pandemic, but elective surgeries came down, and that really hurt our medical device industry. A lot of revenue uncertainty, specifically those with that exposure to the elective surgical procedures. However, most of the companies that we've seen that experience those revenue disruptions earlier on have seen a significant bounce back as different regions open up worldwide because of COVID and COVID lessening, and our elective procedures come back, and there's that backlog of patients that not only needed to have their elective procedures before, but now they need to have them now. We're really expecting that continued growth in 2022. And we also see that our medical device companies, though, are becoming even smarter. So divesting where they need to divest, doubling down where they need to double down, and really looking at performance improvement opportunities with some strategic bolt-ons, as they, especially in the multidiscipline companies that may have diagnostic companies also along with them, being able to take some of that cash and put it into innovative medical device moving forward. So not entirely a bad situation within medical device, and we're going to continue to see that bounce back that we started seeing last year. And I believe we have one more poll question, so we'll go to that next in this section. And that is another quiz for you. What subsector fared least well in life sciences? So we'll leave that up for a minute, and then we'll turn over to our colleagues in healthcare to discuss the healthcare landscape.
Perfect, Kristen. Thank you. So I think Ross and I'll tag team through this, but the first sector to talk about is healthcare IT, and it's very interesting. As always, our survey respondents rank telehealth, electronic health records, clinical workflow as the most attractive for investment. I think just about every year we've done this survey, healthcare IT is number one generally, or it's close to number two. So I don't think that surprises us. If we walk back and think about where the subsector's been, it's been very interesting. 8 years ago, 10 years ago, the original investing was heavily going to be more venture investing. If you guys remember back, population health management tools and things like that were invested in 10 years ago. And you bring that forward as we see it maturing. And even the last 2 years, maybe 3 years, we're starting to even see middle market healthcare IT, where the growth thesis is, hey, we'll knock out the back office and we can get a little bit more scale. And so then even today, and we see some of the big deals that occurred towards the end of the year with Athena Health, you're now seeing even really, really large leverage buyout kind of deals. And so it's been very interesting to watch how this sector has continued developing as it goes through there. As we think about what do we expect for 2022 and 2023, I don't see much of a pause in healthcare IT investing. I think it's going to continue. And I think the areas, because of some of our labor issues, I think any of the solutions that can help with those type items are probably going to be even more attractive in the short term. Now, Ross, I'll hand it off to you to get your thoughts.
Yeah, thanks, Brett. So I mean, from a from a product and service offering perspective, HCIT has been really hot. Obviously, a lot of deals on patient engagement, remote patient monitoring, healthcare SaaS kind of platforms, revenue cycle, a lot of EHR, data and analytics, and what I'll call payer middle office capabilities. And the competition for these assets has been hot. So they're, to Brett's point, there's standalone, there's private equity interest. There's also provider and payer interest for some of these assets. Basically a competition for who owns the patient or who owns the member going forward, and where does their loyalty stand. And in terms of deal theses or value creation, I mean, it is almost a convergence of offering. It's expanding access to additional lives, to powering up new revenue streams, to building kind of what I'll call payer agnostic capabilities for certain payers. And then obviously G&A plays. As some of these platforms come together, there's an ability to kind of scrape out the G&A of one side and create significant cost synergies. Brett, back to you for health systems.
Yeah, perfect. And so I think obviously, Ross, you spend more time in health systems than I do. But the interesting piece here was when we look at the deal activity, they were very active, but it wasn't necessarily mergers or affiliations. A lot of the activity we saw was across the continuum of care. So Ross, I'd love to hear a little bit more about what you saw there in 2021 and 2022.
That's exactly right, Brett. So on one of the previous slides, we highlighted that there was a huge uptick in health systems and hospital deals. And to your point, that's not just health system to health system or hospital to hospital transactions. That can include transactions for ambulatory surgery centers, for physician alignment deals, and for other continuum of care deals, as well as there have been a number of commercialization and other transactions. Starting kind of from the top, as we think about kind of horizontal, vertical, and kind of new business models, there were a couple large deals. You recently saw Spectrum and Beaumont come together, but some of those large deals were blocked. As you think about Steve's prior comment about pruning the portfolio with regards to biopharma, you're seeing the same thing with health systems. There are certain aggregators out there, both publicly traded and private ones, that are pruning kind of assets or divesting certain individual hospitals in markets that aren't core to them. And then conversely, health systems that have significant share of wallet or market share in certain markets are picking them up to densify their standing in certain markets. There were a preponderance of deals in terms of vertical integration, like I talked about, particularly with regards to physician alignment. There are certain we'll get into specialty physicians here in a second, but there are some physician specialties where private practice has been declining in terms of market share, and you're seeing health systems and private equity aggregators gain market share, some of those being some of the hospital-based services like anesthesia and whatnot. And then you're also seeing health systems continue to seek to diversify their revenue streams and their acute care, diversify themselves away from acute care revenue. As you think about the business model for acute care hospitals, they're not seeing the types of increases in volumes and reimbursements that they are seeing on the cost inflation side. So they're seeking very actively to diversify their revenue, not only into other continuum of care settings, and some of those are outside of their core markets, but also commercializing products, forming partnerships with technology companies, doing venture investing, et cetera. And the last thing I'll mention is around kind of the challenge of staffing and nurse staffing. So you're seeing a lot of challenges from a health system perspective, trying to get access to adequate clinical staffing on the nurse and extender front. And you're seeing a ton of private equity platform deals on the nurse staffing side. So back to you, Brett, on behavioral health.
Yeah, perfect. Thanks, Ross. So this one's another kind of mainstay of top places to invest. And if we think about behavioral health, even 3 years ago, 5 years ago, the majority of investing was probably mainly in substance abuse. We think about where we've been with the opioid crisis and things like that. We've seen a shift. Certainly there was a little bit of substance abuse investment last year. Really nice business in Nashville traded that was probably 60-70% substance abuse, 30% more psych. But we've seen as kind of a little bit more of a shift towards what I call the psych side, which could be autism, inpatient psych, eating disorders, things like that. And so we're seeing a lot of investing going there. And the things we know is, I actually agree with the comment that 80% of respondents expect valuations to rise. As we think about an area that's really got some tailwinds from COVID, it's got to be behavioral health. We all recognize the cost of behavioral health in the system. Things have to change for us to manage the true cost of the population. But then the additional stress from COVID that's come to all of us is really kind of making this area a little bit harder to invest in. The one thing last piece I'll add there is we've actually seen, like a lot of the areas in healthcare, labor is becoming a problem as well. We saw a really nice business that came out early in the pandemic. Great thesis, great themes, all these things were doing very well. Had national contracts, all the things that you want to see for scale of a healthcare services businesses, but they're starting to hit some problems because they can't continue growing based on the problems maintaining talent. And so we're seeing a lot of different places, but behavioral health certainly is hitting those issues as well. Ross, anything you want to add there?
Yeah, I would say a couple things we're seeing. One is on the health system side. We're seeing some health systems take on kind of a mission orientation, and knowing behavioral health isn't a particularly profitable service line for them, perhaps because of payer mix and other things. They are finding it important to serve their communities and build out those capabilities. And then to your point, Brett, about the multi-sites that are private equity owned and other aggregators, I mean, some of the value levers or theses we're seeing there is around reimbursement. So obviously, for payers, behavioral health continues to be a huge challenge as a comorbidity and driving up medical costs. So we are seeing payers preferentially pay higher rates for aggregators that provide just wide and broad access around the country. We're also, obviously, behavioral health is one that was the downstroke in volumes were blunted by the advent and increased utilization of telehealth. So the benefits of telehealth have maintained volumes, but on the other hand, it's provided some operating model challenges. So you see a number of what I'll call clinics or storefronts that are running kind of a dual track between in-person and telehealth, and they're trying to figure out how to effectively staff those up from a clinician standpoint to maintain economies of scale. And then to Brett's point, staffing challenges do remain persistent and are prohibiting growth. I would say growth being as robust as it could be. So we're seeing some clients that are looking at doing white space growth work and them utilizing the criteria of kind of clinician availability as a major input or criteria for that prioritization. So Brett, back to you for to kick off specialty physicians.
Yeah, perfect. Thanks, Ross. So we think about specialty physicians, really interesting subsector, and we talk about where they've been and where they're going. I always like to divide this up basically based on acuity. And so your higher acuity, oncology, things like that, versus your lower acuity, dental, urgent care, optometry, things like that. It's a little bit of a tale of two halves. COVID was obviously very hard on a little bit more of the retail businesses and generally the lower acuity. So in 2020, we didn't see many dental deals come out in the fourth quarter. Start getting through the summer of last year in 2021 and through the fall, we did see a lot more activity there. And as we look forward to project that, obviously Omicron put a little bit of a bump in volume, but we do expect to see more and more business coming out there. The one thing that was interesting on some of the lower acuity, more retail healthcare businesses last year was I felt like the bar for the quality of the asset was actually a little bit higher in 2021 than you'd expect. And what I mean by that is we saw several deals on the sell side and the buy side that never traded. And those deals were probably just a little early coming out. Their infrastructure wasn't quite where you'd want it to be. And that deal generally would have gotten done in 2019, maybe 2018. But in 2021, I do think buyers were a little bit pickier. Now, again, there's a significant amount of demand for those assets. Hey, the price is high, but it did feel like the bar for what the quality of the quality of the platform had to be got raised just a little bit. Ross, I'll pause, hand off to you to see what else you've been seeing on the specialty physician practices.
Sure. I mean, I think, Brett, we're segmenting them into probably three segments as I'll think about them. One is the more established platforms around dental, vision, and dermatology. We're starting to see some major consolidations there between some of those. And you're seeing a lot of interesting synergy work there between not only revenue synergies, so service mix and pollination of services that maybe one or the other didn't offer, each other's patients in overlapping markets through all the way through kind of clinic level and MSO synergies. Secondly, would be the platforms that are quote unquote kind of building. So things like women's health, oncology, others. Some of those interesting deal theses there. Some of those are actually starting to take risk that we're seeing, but obviously white space is a huge value lever there. And then thirdly, what I'll call kind of emerging platforms. So some of the cardiology, kind of neurology, nephrology, things like that, where obviously things are just initially kicking off. I think some of those provide some pretty interesting deal theses around pulling technical fees and volumes out of the hospital. So there's an opportunity to kind of search for markets where services are still predominantly done in hospitals relative to other markets. They're more early on the evolution chain. I think we're seeing some strategics venture into physician acquisition here, particularly, for example, take ones that have other care delivery capabilities like ASCs. You're seeing them look at things like orthopedics, cardiology, neurology again, et cetera, just to kind of get those revenue synergies and kind of cross-pollinate or feed the downstream. And then lastly, around risk-bearing physicians, we still continue to see a lot of activity there, lots of interesting deal theses there around risk scoring, infilling current markets with more members or attributed lives, medical cost management and reduction, MSO commercialization, et cetera. And then urgent care. This is one where there's been a huge spike in patients going to urgent care, particularly with regards to COVID. So I think some of the urgent care centers that have had the spikes in volume are trying to figure out, do these patients that came in for COVID and COVID-like services look like our normal, quote unquote, normal patients, and will they be as loyal going forward? And that's a particularly important question on the sell side when you have an asset that's for sale. What is the true kind of pro forma going forward in terms of revenues?
Yeah, that's an interesting point. Is I would say on the lower acuity side, urgent care was one that was really pretty absent for most of 2021 and 2020. We did see a nice business in Florida trade to a strategic at the end of last year, but that's an area I look to see a little bit more active this year because it's very challenging last year. The thesis say, hey, is that volume going to return? Is this just a COVID business? And is COVID temporary? And again, I think most of us are moving towards saying, I'm not sure COVID's temporary. And I think it's going to be part of the themes that were really positive for urgent care, like physician access and how does that become access to a PCP. I think we're going to have a lot more conviction in those. So I expect to see a lot more urgent care deals actually in 2022 and 2023. The one last thing I'll say before we jump off specialty physicians, it's been really interesting to watch this subsector grow up. If we think about 10 years ago, it was heavily lower middle market PE, maybe middle market PE. And we'd see assets, dental and things like that come out. First time we saw them is 75 million of revenue. All right, 4 years later, after that hold period, we'd see them again, they were 200 million of revenue. And so we've seen now those that transition, some of these businesses are getting very, very large. And a lot of our clients had always asked us, said, hey, Brett, hey, Ross, we appreciate you helping us buy them. We appreciate, the optimization work you've done. But the questions are getting a lot of those now is different of saying, hey, we really need a lot of help with ERP implementations. We need a lot of help with systems implementations, the things we weren't talking about 5 years ago, or IPO exits. So it's been very, very interesting to watch this subsector really grow. And now there's a lot of big businesses with over $1 billion top line where the only logical exit is most likely an IPO. So again, really interesting to watch this sector grow up. Maybe the next one I'll jump into is home health and hospice. As we work backwards there, a lot of the key themes for investment are still there. It's an aging population, it's the right cost setting, it's all those things that are there. I think if you talk to, so the fundamentals are great. I think if you talk to a lot of the corporate development folks at the larger strategics, to say the problem we have now is that it's a very busy place for acquisitions, and trying to get any acquisition to scale is going to be more and more expensive. And so when we look at this one and say, hey, really like the sector, a lot of great tailwinds. I expect to see some larger transactions done this year for various reasons. But it's one that's really getting hit heavily by labor as well. So you might see, again, my comment on organic pressure. I'd expect to see a little bit here on home health and hospice.
Yeah, your last point, Brett, is actually really really interesting. I think with the advent and increase of personal care also, which we've seen kick up in the last kind of 12 months. Personal care is an area that's picking up a lot of steam with COVID and obviously with the aging of the population. There's huge competition for labor from those folks as well, from home health and hospice. But on the deals that we've seen, I think the deal thesis continues to be a little bit more revenue in orientation. We've seen kind of private equity companies with either SNFs or risk-bearing physicians or others look at buying home health and hospice assets and try to calculate the amount of revenue synergies via more referral integrity and referral loyalty volume there. So I think that's pretty important. And then also kind of the preferred provider agreements with health systems and trying to preferentially steer volume there to home health and hospice as well.
Yeah, I think it'll be really interesting to watch this subsector and the impact of risk has on it. And I don't think it's a 1 or 2 year type thing, but over the next 5 years to see how it is. We can see it working around the fringe right now, but I think it's going to get more and more pressure in the coming years.
Totally agree. Totally agree. So I think we'll move on to our next polling question. So what sector do you expect to have the largest valuation increase in the coming 12 months?
Hey, and maybe before we get into the path forward and kind of as a wrap up, a couple of questions that I've seen come across and one kind of thinking through this last comment on home care hospice, how do we see some of the potential distribution type companies trying to add some of these sort of services to kind of have a full end-to-end kind of customer value chain? Do you see that happening in 2022, or do you see the kind of those larger distribution companies not getting into that space? So maybe Ross or Jeff or Ross or Brett, any thoughts on that?
Yeah, I think I think it's an interesting way. I think would need to figure out where to play in the value chain. Is it through the distribution or is it through other fronts? I think owning home health and hospice overtly is a very expensive proposition. I mean, as Brett would tell you, valuations are extremely high. But I think to your point, Steve, there are winners and losers amongst the device manufacturers and things like that around kind of from a market share perspective that are seeking ways to kind of push market share in the market.
Good deal. Thanks, Ross. Another question that came in was around some of the headwinds and how we'd see that headwinds with inflation, and will that have an increased cost of capital? What do we see that might drive there? Any thoughts on that? Maybe Jeff or Kristen kind of throw it to you guys.
I think it really depends on the deal types. I think, for the most part, when pharma is pursuing innovation, I don't think for most companies, given how well many of them performed through COVID and came out cash rich, I don't think it will be a huge headwind. Even with JP Morgan, predicting 7 rate increases, I don't think it's going to be a huge deterrent because they need to preserve those pipeline assets because that's their bets on future revenues. I'd also argue there's so much competition over innovative assets and the need to be first to market. That's going to be a stronger pull than the cost of capital at this point.
Yeah, thanks for that, Jeff. And kind of recognizing where we're at from an overall time perspective, just maybe a couple of things here. Hopefully, I think you can tell that we're very excited on the M&A front and what we see, coming from 2021 that's been driving 2022, really across all the subsectors that we hit today. I don't think there's one that we called out and said is just going to continue or is going to decline in a rapid fashion in 2022. So a lot of excitement there. I think, Jeff, your last point is we're all still looking for those kind of diamonds in the rough, right? Those innovative assets at a price that we can afford. That's not getting out there, extremely high. But in the same vein, I think we're also seeing a lot of new and creative deal structures. I think, Kristen, you talked about this earlier. We're seeing more JVs, we're seeing more alliances, VC funded acquisitions or investments there, kind of the try before you buy. And then we're seeing them, some of those now kind of going through all the way to the end. So a lot of good excitement. I think I'd say hopefully today you've heard some some interesting points that you can bring back that's specific to your sector and subsector. Again, I want to first of all thank the panel for jumping on today, and then also thank everybody for taking the time out of their day. Hopefully you got some good information coming out of this. Also, please remember that you have to check out here. That popped up pretty quick. Answer that last question so you can get that CPE credit. And just want to thank everybody for taking their time. We look forward to hearing more from you. If there's any questions or you want to, dive into some of the specifics and deeper, please feel free to reach out to us, and look forward to a happy and safe 2022. And I think we'll leave this up here for a couple of seconds so people can answer it. And when you did, thanks everybody. Have a great day.